Will they, won't they? The debate over Fed policy gets murkier by the day. Stronger than expected jobs data on Friday sent markets higher. Now that's a glass half full approach, considering it might mean more tightening from the Federal Reserve. But then you also take a look at what about the investment community? What's that telling us? April data from TD Ameritrade gives us a gauge of overall sentiment. Its Investor Movement Index, or IMX, ticked higher again in April, though it still hovers at relatively low levels. Is it a case of cautious optimism? Well, joining us now is Alex Coffey, TD Ameritrade Senior Trading Strategist. Good to have you on the show here. So, Alex, give us a gauge of where we're seeing the flows for investors and the sentiment.
Yeah, so first off, thanks for having me. We are seeing a steady, kind of slow but sure recovery of sentiment through the TD Ameritrade Investor Movement Index really all year long. And this is after bottoming out in November and December of last year at levels that really we hadn't seen since March and April of 2020. But where we're seeing the actual buying and selling activity take place on a stock-by-stock basis is actually quite intriguing. And the reason that is I see it as somewhat contrarian. We're actually seeing investors being a little bit more tactical in their positioning amongst the names. If you look at some of the names that were bought, for example, of course, you see Tesla in there, which has been, of course, a recurring name that we've seen for the better part of the last few years. But this is a name that had struggled a little bit over the last, let's call it, month and a half or so, as its price cuts had really started to weigh on its margins. We've first heard from the company on its earnings release during the month of April, and the stock, of course, struggled a little bit. So a little bit of a buying into some of that recent weakness, all things considered. Also, some real estate investment trust companies like Realty Income and Medical Properties Trust popped out as well. And that's sort of a contrarian trade in the sense that those are names that have actually struggled, but have shown signs of attempting to bottom out and maybe start a recovery. Combine that with some of the macro that we'll talk about in just a moment, it could actually make a little bit of sense in terms of the thinking there. And then on the sell side, a lot of big tech names that have done really, really well, particularly in April. Meta platform surging all year long, bouncing in the month on its year of efficiency, continuing to show up on the bottom line. Apple, slow but steady, continues to be a strong name for investors. And then in Microsoft, it's been a centerpiece in the AI conversation and actually saw margins expand, believe it or not, in that tech space in its most recent earnings. So a little bit of a rotation out of the outperformers and trying to rotate into some of these names that have maybe struggled a little bit.
And so why do you think we're seeing this contrarian stance then?
I think this is just investors as they've gotten access to more and more information from shows like yourselves and, of course, some of the education that's provided by places like TD Ameritrade and elsewhere. You actually just see investors, of course, looking for things that are moving. And oftentimes you'll see, of course, names that are kind of hyped at the time. AI has, of course, been a big discussion, will garner attention. But also just the old adage of the attempt to buy low and attempts to sell high. Of course, many investors are still relatively passive in their approach, but those who are active are trying to be tactical and not always just jumping on the momentum train and try to follow things higher or lower as those movements are happening.
And we know you also pull out the millennial demographic there too. Are we seeing a very different behavior from them versus the rest of your investors?
It's mostly saying the same, of course, a little bit different approach. Some of the time horizons are going to be different. So we've seen different reactions at time. But I would say in terms of this particular month, a lot of the same trades. You do see an increase in the millennial index, a lot of overlap in some of the names that were being purchased, but also both segments, both the overall TD Ameritrade client population and millennials were both net buyers of equities as well, which of course is showing sort of that sentiment starting to come back. Of course, this factors in things like fixed income and interest-bearing products as well, which of course have gained a lot of attention with the interest rates coming off zero in the last year. But we are seeing buying activity come back into equities. And of course, some of those product mixes are relatively similar between the two populations.
And you mentioned interest rates, more data for the Fed to get to digest this week. You have CPI, PPI coming out as well. And on top of that, we're seeing something of a comeback in regional banks, but we're still sort of waiting to see some stability across the board. At what point do you think, in terms of the regional banks, will the bleeding actually stop?
Yeah, it's a really, really good question. Obviously, tension is high, but it has certainly dissipated over the last few sessions. And, this is one of those situations where information is going to be key. Sometimes it's going to be speculative. Sometimes it's going to be not so speculative, and it's going to be good news. It's going to be bad news, and we're going to see ebbs and flows. I do think it complicates the process for the Federal Reserve. It complicates the process for investors and trying to figure out exactly where things go from here. I think for the first time in quite some time, we have a very interesting Federal Reserve meeting coming up, because I think an argument could be made for all three actions, both interest rate cuts, interest rate pauses, and of course interest rate hikes, depending on what the data may be going forward. Right now, of course, about a 90% chance that it's going to be just simply a pause, which is sort of playing things down the middle. But there is still, at least in the last check that I had, about a 1 in 10 chance of another 25 basis point hike. We may have more clarity on that, as you mentioned, some of the inflation data that's slated to come out this week that could provide further clarity there. But what really interests me as we look ahead to the rest of the year is just how divergent market expectations are from the words of the Federal Reserve. And the only way to make that make sense is that the market is pricing in for either significant more uncertainty in the financial sector, or, of course, a pretty significant downturn fairly abruptly here in the economy.
And Alex, I want to stay on that, so do stay with us. I want to get to our chart of the day with concern over the stability of the banking sector. It's still lingering. Let's take a look at the KBW Banking Index. So here we see a 10-year chart, which Alex points out suggests that bank stocks may have another big drop in them. He says if we hit the support level on the chart, the index would be down about 60% from its January 2022 high. So let's get back to Alex Coffey, TD Ameritrade, Senior Trading Strategist. So do we have an idea of how severe that drop might be and what perhaps might change that trajectory?
Yeah, well, what's going to change the trajectory is we're going to need stability to take hold in the regional banks and the financial sector as a whole. As you mentioned, though, optimism has started to creep back in the last few sessions. This banking index, of course, though, did capture all three of those major banks that failed or were taken over through receivership: Signature, Silicon Valley, and First Republic. So it used to be 24 members, now down to 21. That, of course, is factored into some of that downside. It also captures names like Western Alliance and Zions. So you do have some of those fearful, names that have come up over the last week or two, last couple months that are constituents of this index. But you pointed out, you can just see how much damage has been done in fairly short order. We're getting back to levels that we haven't seen in several years. And so this is something to watch. Of course, that line there at the bottom there is tracing back all the way back to 2016. So looking for some of those levels along the way. Of course, some of those levels from the middle of 2020, we're approaching that around 70. Of course, the depths of the uncertainty of the pandemic as well, a little bit below that. So a couple levels to look there along the way if the uncertainty continues or even potentially builds from here amongst those, not only just regional banks, but primarily that's where the focus has been. But names like Bank of America and JP Morgan, of course, are included in this index as well.
It's true. When you think of the banking fallout, it's also that psychological sort of crisis of confidence that's adding on this as well. A big thank you there to Alex Coffey, TD Ameritrade Senior Trading Strategist. Thank you for joining me today.